Trump reversed course. Ships that were once banned are now being shipped directly into China, but not without conditions. Inside a sealed briefing room in Beijing, China's Cyberspace Administration, according to Reuters, summoned Nvidia executives to address serious security concerns tied to the H20 chip. Regulators demanded proof that the chip lacked any remote shutdown or tracking capabilities. At the same time, People's Daily, the official mouthpiece of the Chinese Communist Party, issued a direct challenge. Nvidia, how can I trust you? This standoff isn't just about semiconductors. It's about control over infrastructure and future technological systems. Just weeks earlier, the Trump administration had tightened AI chip restrictions, effectively banning H20 sales to China. Nvidia responded by writing down $4.5 billion in inventory. AMD, according to Bloomberg, flagged an $800 million loss. But mounting pressure from financial markets changed the political calculus. Faced with weak demand in U.S. Treasury auctions, soaring interest costs, and growing investor flight toward BRICS currencies, Washington reversed itself. Bloomberg reports that Nvidia was granted permission to resume selling H20 chips, though only older models. According to U.S. AI security advisor David Saxes, the intent wasn't to empower China, but to prevent Huawei from achieving domestic dominance. Yet the contradiction is hard to ignore. The U.S. is now actively enabling chip sales to China while simultaneously accusing Beijing of surveillance and intellectual property theft. And China isn't accepting these shipments without scrutiny. It's demanding proof, safeguards, and comprehensive audits. Reuters confirmed that regulators are inspecting Nvidia's chips for backdoors, even as Chinese firms line up to buy them. Meanwhile, Nvidia has ordered 300,000 more H20 chips from TSMC to meet surging demand in China, according to Windows Central, showing how commercial urgency is now overtaking strategic caution. The same chips Washington once called a national security threat are now a form of diplomatic currency. The Wall Street Journal notes that this reversal is drawing bipartisan criticism. Lawmakers say the Trump administration has abandoned long-term containment goals for short-term export revenue. Industry insiders are warning the president's concessions under economic pressure will become strategic liabilities. The irony runs deeper. The H20 chip was specifically designed to comply with Biden-era export controls. Now it's both a second-tier product and a central bargaining chip. According to the Financial Times, this loophole is accelerating China's efforts to develop domestic alternatives. As the U.S. attempts to walk a fine line, BRICS is moving in a very different direction. According to Reuters, the bloc's finance ministers have formally proposed an alternative international monetary fund quota structure. They've also endorsed a new credit guarantee mechanism under the BRICS New Development Bank, denominated in local currencies. This isn't speculation. It's institutional divergence. And it's more than diplomatic maneuvering. AP reports that Trump just slapped a 25% tariff on India for continuing to purchase oil from Russia. China was warned that similar penalties would follow if it didn't scale back. Both countries rejected the demands. India's foreign ministry called its energy strategy time-tested. China asserted its sovereign right to buy from any partner it chooses. So while Washington penalizes India for its energy choices, it still asks New Delhi to remain a key player in the Indo-Pacific defense strategy. While it accuses China of distorting AI markets, it continues selling China AI chips to avoid worse outcomes. While it warns BRICS not to bypass the dollar, it imposes tariffs that push them to do exactly that. Let's pause here, because up to this point, this looks like strategy. But is it? A month ago, the Bureau of Labor Statistics revised U.S. jobs data downward by 258,000, according to the Wall Street Journal. Markets dropped 3% on the news. The White House blamed the data agency. Trump threatened to fire its director. But the real issue wasn't statistical, it was structural. At the same time, Reuters confirmed that the Federal Reserve refused to cut interest rates. Jerome Powell announced that rates would remain steady through at least September. In effect, fiscal tightening continued even as the labor market showed signs of cracking. In response, the Treasury adjusted its auction strategy. According to the Financial Times, long-term bond issuance was cut by $2 to $3 billion to avoid further upward pressure on yields. Instead, the focus shifted to short-term debt, where borrowing costs are less immediately visible but more dangerous over time. The borrowing requirement for the final quarter of fiscal 2025 is now expected to surpass $1 trillion. That figure, per Bloomberg, reflects a deeper erosion of market confidence. Foreign participation in bond auctions is declining, yields are rising, and financial pressure is mounting. Here's the contradiction. Washington is trying to attract capital markets with promises of stability, while simultaneously escalating a tariff war that disrupts global supply chains. It's pushing Nvidia chips into China, while warning that their use poses national security risks. But China isn't waiting. The state is aggressively funding Huawei and SMIC. According to Bloomberg, Huawei is now testing its Ascend 910D chip, a power-efficient alternative to Nvidia's H100. It doesn't need to outperform. It just needs to be cost-competitive. Once it reaches parity, China will expand globally. Huawei's chips won't just serve domestic needs. They'll be exported, especially to markets the U.S. can't sanction. BRICS, ASEAN, the Global South. And they'll be cheap. Meanwhile, reshoring remains a challenge at home. The Wall Street Journal reports that AMD estimates chips made at TSMC's Arizona plant will cost up to 20% more than those made in Taiwan. Without subsidies, they're not viable. But subsidies come at a cost, debt. And debt markets are turning hostile. The U.S. wants to dominate AI, but if it loses cost competitiveness in chips and labor, while alienating energy and capital partners, what leverage remains? Even the policy objectives are starting to contradict each other. According to Reuters, Trump now supports the Chip Security Act, a bill requiring exporters to embed tracking modules in high-performance chips. But that very concept triggered China's backdoor investigation in the first place. What Washington calls safety, Beijing views as sabotage. Jensen Huang, Nvidia's CEO, praised China's AI ecosystem in a recent interview. At the same time, his company is under investigation by that very ecosystem. He wants access. They want assurances. The trust gap is growing, even as sales continue. According to Bloomberg, the BRICS bloc expects semiconductor demand among its members to exceed $210 billion by 2032. That's not theoretical. It's a real shift in global demand, away from Western firms, toward local producers. This has consequences. The U.S. is funding its trade war with increasingly expensive debt. Jobs are being lost. Supply chains are being rerouted. American exporters are stuck in a contradiction, punished if they comply, punished if they don't. And all the while, BRICS is building alternatives, not out of ideology, but out of necessity. The cost of relying on a weaponized dollar or a volatile chip policy has become too high. At the core of this unraveling is something deeper than tariffs or semiconductors. It's trust in American consistency. According to the Financial Times, since Trump's reversal on chip exports, multiple EU trade envoys have privately warned their governments that U.S. industrial policy is becoming tactically unpredictable. Germany's Economic Affairs Ministry is already preparing a contingency framework to fast-track tech licensing with China, bypassing U.S. regulatory bottlenecks. Meanwhile, Reuters confirms Saudi Arabia and the UAE are in early talks with SMIC and Huawei to build local AI chip design hubs, funded by sovereign wealth. If successful, these Gulf nations could leapfrog Western suppliers and integrate into China's AI ecosystem. It signals a broader fracture. The global split is no longer East versus West. It's rules-based versus outcome-based. That's why Vietnam, Indonesia, and South Africa, traditionally seen as swing states, are now attending BRICS Plus forums, exploring alternatives to dollar clearing systems. According to Bloomberg, the BRICS New Development Bank has already opened bilateral credit lines to fund semiconductor equipment deals without SWIFT. This isn't deglobalization. It's reglobalization under new rules. And if Washington doesn't reestablish its credibility soon, it won't just be chip sales at risk. It will be the entire system. So what comes next? Does China permit Nvidia to sell in exchange for technical insights? Does India continue to grow its economy on discounted Russian crude? Does BRICS finalize its IMF alternative and undermine dollar dominance from within? The old rules are breaking down. The U.S. wrote the system. Now it's rewriting the exceptions. It started the chip war. Now it's sending the chips back. It demanded compliance. BRICS said no. It promised jobs. The data says otherwise. This isn't collapse. It's recalibration through forced guarantees, rejected orders, and a retreating job market. And if Washington's next move is to demand foreign governments buy more U.S. bonds to stabilize its budget, that won't be policy. That will be surrender.